All right, Gordon, can you see my screen? Audio is working great.
Yep, everything's good.
All right. Well, I know we'll have a whole bunch of people trickling on, but let's get rocking and rolling. Welcome, everybody, to our Quarter 2 2025 market report. Already got a bunch of our great agents around the state. Welcome, everybody. Got what? Amber, Audrey, we got Cam, Dean, Justin Yoder, Devin, Lori, Melissa, Sally. All of you, welcome, welcome. I'm so excited for you to blow up the chat with all your insights and intelligence on where this market's going. Because me and Gordon, after days and days and days pouring into stats, we still don't know where we're going to end up, right? Our projections, at least, have gotten a little funky as the market continues to be intriguing. But let's get rolling. Couple of things, housekeeping, as always. Gordon spends a lot of time on this report. Shout out to Gordon. Thank you for all this. He is our resident economic expert. We spend probably more time talking about the real estate market than anything else as we chat multiple times a week. So a couple things. So we always put this report together. Gordon is fantastic at putting the PDF slides on kwutah.com. Just to make sure you're using those, just click the resources link at the top right, agent resources, and then quarterly market report. We do record this, kwutah.tv. So this will just direct you right to our YouTube channel. And one of the new things we're doing this time, if any of you have used ChatGPT's deep research feature, I actually connected the market report to my ChatGPT, did the deep research report, and it spit out about 10 pages of talking points. So just really analyzing the data, trying to help interpret what is the data telling us about the story of the market. Might even give you a bunch of great points for your buyers and sellers. So that will also be downloaded PDF-wise into the folder for your reference if you want to geek out and nerd out on some of these stats with us. Couple just quick class announcements. Now I got a few of you on. Shoni Ivins and Kimber Walton, our technology director for KW Utah, and then the CEO team leader for KW Westfield, Shoni. They are doing an AI training series. If you have not been on the last couple, you are very missing out on some fantastic artificial intelligence training and integration implementation in your real estate business. I think this is the third, maybe fourth one. August 22nd, 11 a.m. AI Business Systems Workshop. And then I taught curve visioning a little bit ago, but we're going to be teaching the next two pieces of that, just Zoom. Kimber always gets these CE certified. So thank you, Kimber, on that. But September 5th, 10 a.m. to 12, just on the 30, 60, 90, and then success through others is coming up. And then I think a few of you will be down at Mega Camp. So looking forward for you guys to see each other. But let's get rolling on the market report, Gordon. Quite interesting. And I think the federal economy is kind of what's helping drive a lot of what's going on in our real estate market. But one of the things, the word recession, as some of the other pieces of the economy kind of get caught up with the terms of recession. Recession means falling mortgage rates. So the closer that word ripples across the economy could lead to obviously mortgage rates, but there's some truth to the idea that a recession could bring lower mortgage rates. This is just the last several recessions, the last six recessions, and what mortgage rates actually did during that time period. 81 dropped 5%, 2008 down 1.13%. And we'll talk a lot more about the rates. The Fed just met yesterday. But a recession does not always mean falling prices. So here's those same last six recessions. What did prices do on average across the country for those segments? So up 6% 2020. Clearly, it was just that great recession that dropped a bit.
Yeah, I tried to put a little bit more data in this market report because we're seeing a lot of headlines where the sky is falling, repossessions, all of this stuff. And it's like, that's really not what the data is showing. But they're doing a lot of the clickbait right now, and it's affecting the buyers and sellers on how they're viewing the market.
Yes, yes. Totally agree. And thank you for doing that. And, I know that we were spoiled a little bit in 2020, 2021, just a record amount of transactions, prices were skyrocketing. But really, what we're seeing the next 3, 4, 5 years is just kind of just slow, steady, sustainable growth that we'll see in the real estate market. Kind of what we've seen the last year, 2 years. Probably a lot of those trends are going to continue in the near future. Price is expected to rise more slowly over 5 years. So, over 100 leading housing market experts were surveyed in the latest home price expectation survey that Fannie Mae collects. Their collective forecast shows prices are projected to keep rising over the next 5 years, just at a slower, healthier pace than what we've seen more recently. And that kind of steady, sustainable growth should be one factor to help ease your fears about the years ahead. So here are the actual projections that were the averages of a lot of those projections: 2.78, 3.38, 3.74, 3.68. Talk a lot about that 4% appreciation trend, but just this is kind of a little slower, steadier, just to help us get that affordability caught up potentially. And then here's another one. So this is also from Fannie Mae. The average projection is about 3.3% price growth through 2029. The optimists, which I would put myself in the optimist category, we see growth closer to 5% a year. You can see that top teal trend line right there. But even the pessimists still forecast about 1.3% growth per year. Do they all agree on the same number? Of course not, but here's the key takeaway. No one expert group is calling for a major national decline or a crash. Instead, they expect home prices to rise at a steady, more sustainable pace. So even you pessimists, Gordon, still are projecting slight appreciation growth over the next 4 years.
And I'm in that group.
And I think if there was one thing that most realtors were very hopeful of 12 months ago, we often on this report will say, who believes 12 months from now, rates will be higher, lower, whatever. We haven't seen the decrease in rates that we were optimistic of even a year ago, right? We know the Fed just met, inflation's, doing pretty well, in the 2 point something percent. We'll get to that. GDP still is coming out a little bit higher, but just the odds of significant mortgage rates decrease has gotten more rare than we think it is. So
Yeah. Well,
uh,
and even like you and I discussed last year when they reduced the Fed funds rate, but they continued to decrease the Fed holdings, it's making those rates stay the same or even bump up.
yeah, we've seen a full percent drop in the Fed rate the last 12 months. We haven't seen that necessarily in the mortgage rates
Right.
because they're also selling off assets, which is tightening the mortgage credit market. So just that margin between the Fed rate and mortgage rates have just stayed a little thicker than we're used to. Okay, let's look at this NAR versus UAR. You can see NAR nationally just has turned down. We have less realtors in the country than we did a year ago, 2 years ago. We started on that trend and kind of turned around with a little bit more live data, and I think it's actually gone up. I don't know if you saw Clyde's report, but I think we're at like 19,700 or something now.
Yep. That's Utah's numbers. I do not
Mhm.
have NAR membership numbers anymore. We've got through December. I'm hoping that we'll be able to get through December of this year.
Yeah. So here's just the total Utah snapshot. Year to date, just mainly look at the right columns. Year to date, 25, the first 6 months compared to the first 6 months last year. New listings, we nose up, right? Listing inventory is going up, days on market's going up. Pending sales, virtually flatlined, but down just 1.4%. Closed sales, this is also the one we thought rates might be a little bit better by now this time last year, which we thought would drive units up. But we are pretty much flatlined, slightly up, even though we started the year a little down. Quarter two, the spring kind of caught us up a little bit and surpassed last year. I think we're still generally Salt Lake Board, the Utah economic report that they give the governor, they're projecting more units this year. I think about a 2% growth is kind of what I've seen the most common trend. So, but it's going to feel a lot like last year. Days on market up 10.7%. And again, they're 1% growth on the median sales price so far, which projected maybe 2% this year is what Salt Lake Board said. But then percent of original list price, 0.3, down 0.3%, pretty much flatlined right there. I think it was only about 27% of homes sold for more than list price so far this year. So still a significant chunk of houses are selling right around that 97%. And housing affordability, although it has held steady, we still don't necessarily love that number. Affordability continues to be a challenge. But inventory, here's the story: inventory of homes, which hopefully is for the most part good news because more homes are finally coming on the market, but up 28%. So far, 83,000 homes this year inventory. Month supply also up 21% to hit that 4 months. So let's just jump into the categories. So we always hit the major categories. We will jump back and forth between the nation and Utah just to give you some comparison. Here is existing home sales. You can kind of just see flatline right around that 4.1. Even some of the news reports, when they annualize that number, puts you somewhere around 3.9 million, 3.93 million homes sold on an annualized basis. So still pretty low. So the fact that 23, 24, 25 felt very similar takes us all the way back again to the mid 90s when we were at that number. And then this overlaid green line, I had Gordon throw on a couple market reports, but this is percent of households that are actually selling. So our population has grown the last 20, 30 years. Right now, it represent only about 3.1% of homes sold. So even in the heydays of the 2000s, you saw us get up to 6.3%, even 21, 4.7. So just more households getting them sold. Here's on that annualized kind of basis, 3.9, 2025, 3.9, you got 4.0. But Gary always says that he feels like that's the bottom, right? When they do the market report, it's hard to think that we will go under that. So the fact that that's the baseline. Here, this is a new report you did, Gordon. So you actually went not seasonally adjusted. You wanted to see the actual homes sold per month in the state of Utah. And you can see
National.
every single month you can see how we've dropped, right? Other than last month. June was a positive sign that there was more homes sold in June this year than last year. Any comments on this one?
Um, Looking at the trends, I'm hoping that the remainder of the year kind of follows 2009 and we start seeing those numbers in a positive reflect going forward into 26.
So this report's projecting 1941,
That's what we've got currently.
and the time below that was 2009.
Yep, January through June national numbers.
Okay. So here's annual new homes sold. So this is new construction homes year to date on pace for 653. And we'll talk a lot more about that builder data, but just, we kind of went through a little bit of wave and we're starting to see a lot of that new construction building permits kind of actually taper down, which could, exacerbate the supply issue that we have. Here's U.S. new homes sold on a monthly basis. But let's talk about Utah. So again, Utah, we are trending just slightly above where we were last year, 0.4% above. But you can see total 2024, we ended somewhere around 41,654 homes. So we end up somewhere around that number, maybe 42,000 if we don't see a big bump up. But you can see the 22-year average trend, 43.2 thousand. So right at that line, but still slightly under that last year and maybe this year. But then you can see even percent of households sold as well, 3.55%. Monthly basis. Let's talk home prices. Home prices, 412,000 price right now across the country, which is 6.8% above that trend line. Which again, we were way above that. Great Recession took us below that. Just the appreciation we saw as COVID happened and just the money that was pumped in the market went well above that trend line, and now we're getting a little bit closer, especially if you actually are projecting below 4% appreciation over the next 3, 4 years. We might end up catching back down to that 4% trend line. By month, you can see 435 last month at the end of June. Mortgage rate was right around 6.82% nationwide. And then median payments. If you take 20% down, principal interest payment on the median mortgage rate at the median purchase price, this gives you a 2,275 median home payment at those numbers. It's pretty high. Still, Utah home prices 505 year to date. About a 1% growth right there. And again, right around that 2022, when we map that same trend line, just, doesn't mean this is necessarily the story, but we just know that the Utah prices have dramatically outpaced the United States prices, which has put us, what, I think ninth most expensive medium price market in the country was the last report I saw. Ninth most expensive. Utah home prices by month. You can see just last month we ended up at 515,000 price, median sales price around the state. And what's the story in this, Gordon? Because overall, statewide, we've gone up, 1 to potentially 2%. But, when you really dial into the different markets, like I love watching our St. George marketplace and all of our great agents down there. I love seeing Park City, across the Wasatch Front, even Logan these days, watching all those markets. It's almost like those prices at the median purchase price or even the affordable below that you're starting to see a decline in prices. You've even seen a lot of other marketplaces around the country as they've moved more into an extreme buyer's market. You've seen prices soften. You've seen some depreciation, but it's interesting when you compare above the median price, especially when you go into like the Wasatch Back, Wasatch Summit, prices have gone up still. You look down in St. George, a lot of these either luxury or lifestyle type of markets are very, very resilient. So even though we've seen price increases there, I think you're going to start seeing a lot of the growth of increase in units and potentially some of the price softening in a lot of these like condo complexes, even townhome complexes, some of the ones that I own rental properties. We were at 380 on some of our condos just 6 months ago, and we've already seen sales coming at 350, pretty dramatically. Even Salt Lake County has seen prices soften a little bit across the county. Even Salt Lake City specifically, they've seen price drops. What I think I had down here 6 or 7% drop in Salt Lake City, primarily for some of those affordable. Any comments on that,
Well,
Gordon?
yeah, no, it's like we discussed yesterday. It's that messy middle. The that move up buyer really wants to move up to that median middle income, but they can't because the payment is too much due to interest rates. So they're kind of stuck in that area, and that messy middle wants to move up again, but they can't. So it's kind of domino effect of that.
Yeah, yeah. And especially the renters that
Yeah.
never got in the marketplace, never owned something, it will still feel like they're chasing it. And then, some of them believe they won't be able to catch it. Here's the Utah median home payment. When you take that 20% down payment, principal and interest, median rate at the median price here, 2,691. So again, almost double after 4 or 5 years of just those prices going up and interest rates going up.
And when we get to the rental, I did another spreadsheet on that, and I was really surprised at over the same time frame, it's basically almost double as well.
Really? Hmm. So here's the comparison between the United States median price and then Utah's. So you just saw we were together forever. We started separating from the United States as just our growth of population was great. Our economy was great. A lot of just fantastic companies. A lot of the economic principles that our state government kind of run by really put us in a very healthy spot. We can traditionally win all top state economic awards all the time, which really fueled the growth of the prices. So again, we saw a little bit of reprieve in 2022 to 23. So the gap slightly closed, but we're still, almost a full 100,000 above the United States on median price. And here's just kind of over some of the other time periods, recessions, major historical events. You saw, the pandemic, high inflation up 21.35%. You saw, Fed raising rates, the Great Recession. So just kind of tells a story what's going on economically or even globally. So here's annual appreciation. Year to date, the country is at 2.5% appreciation, 4.5 last year, 0.9 the year before. But again, just some really high years when a lot of that COVID money was hitting the market. And then you look at Utah, 1%, 1% last year, 3.3. We dropped 5.1. And then again, that year, 2021, that was such a crazy year, crazy year. Remember having condos under contract. By the time they closed, I had like 100 grand equity in a condo from under contract to finally closing on it, which is just, it was a very stressful time for agents. They were working many long hours. US inventory annual up to 4.2 months, up 18% from 24. Here's on a month-to-month basis. You can kind of see it just trickling up. the last 6 months. Pending home sales slightly down, a little less under contracts, going under contract so far this year compared to last year. And even the cancellations, you've seen that hit the news too. We don't have a slide for that, but the cancellations of under contracts has been really, really high. Even builders, the quantity of builder closed transactions, the quantity of money and concessions builders are throwing into the market also has kind of created some unique circumstances in negotiation. But here's pending home sales on a monthly basis. But here's new single family housing units completed, 9.9. You're looking at that's in thousands. But the trend line right there is around 12,000, no, 12 million. No, what is that? 1.2 million? 1.2 million is the 55-year average. Usually we got to be building at least over a million homes. Some economists even say we need to be closer to 1.9 million homes built in the country every year. We haven't been eating into that inventory issue. Building homes has gotten expensive, a lot of the risk, money being expensive. We're seeing the trend going backwards now, and we'll hit that on builder permits, but it almost feels like we're going to drop off a little bit of a cliff from the lack of builder permits being pulled right now.
And that's why we don't really forecast that the prices are going to go down because we're not building enough to even make up for the last decade.
Yeah. So we're compounding, at least in Utah, we're compounding the inventory challenges over the next 3 years projected, not easing the inventory challenges, which you're right. That's why those prices are going to remain sticky, regardless of affordability being at record lows, with rates being kind of sticky at that, 6 to 7% range. Here's even the projected housing demand. We show this. These are the most updated numbers, 2024 to 30 projected housing demand by county. Utah County wins that lot. 44,000 homes need to be built. 42,000 there in Salt Lake. Even look at Washington County, 22,000 homes. St. George, all that area is growing tremendously.
Yeah, where is St. George going to come up with the land for 22,000?
Right?
That's a
Get as,
lot.
get as close to Vegas as possible.
You're right.
Annual months of inventory here in Utah, 4 months. So we have jumped 23.1% on months of inventory. Again, that balanced mark right there. And I keep wanting to point out because it does feel so dramatically different. Inventory is way higher, days on market's way higher compared to what we just came out of in the COVID days of 2020, 2021. But again, when you reference back after the Great Recession and the really high inventory levels that we have, it just kind of puts it a little bit more into comparison that we're nowhere near where we were after the Great Recession as far as inventory, days on market. We're at 4 months. The peak we got was 12.1 months of inventory back then.
And even
Here,
though it still looks like we're in a seller's market, it's like the market is split. Part of it is a seller's market, part of it is a buyer's market,
yeah, yeah.
even nationally.
Yeah, we inventory wise, we for sure in a seller's market, but just the fact that a lot of sellers, which we'll get to those numbers, but 80% of mortgages in the country are under 5% on their mortgages, which that just adds another little Uno reverse card on sellers having the ability to just not list their home or stay because they want to stay in that low rate, right? So here's new listings. So this is the new listings coming on the market. We're up 11.2% year to date from where we were in 2024. Last year, we saw 57,941 homes come on the market. If we're up 11%, you got to assume we're somewhere around what, 63, 64%. So that, I mean, 63 to 64,000 new listings coming on the market. This isn't inventory. This is just the new listings coming on the market. So that will put us above that 14-year trend line potentially or right at it. But we'll see how the last 6 months go. But I think that's probably fairly accurate to stay. But here's percent of residential listings sold. Sorry. You can see new listings is the blue line, sold listings is the orange line, percent of new listings that sell. We've been hovering right under that 75% of listings sell. You look at COVID times, which was crazy, almost everything sold, 90%, 9 out of 10 listings, no matter what happens, you put it on the market, no matter what your photos on the MLS look like, no matter what, it'll sell, right? We're down a little bit below 75%. You can see even down to 2011, it was 50%. 50%, you had a 50% chance of your listing selling. You can see how it kind of shoots up a little bit in December as less homes come on the market, more closings come out. But here's inventory of homes. I know a lot of our agents like to just jump on whatever their local MLS is. You know, mine's the UtahRealEstate.com. Just the other day, I pulled it up. All active listings, 13,500-ish was on the market. So this is basically taking that number throughout the year. So if you see this like June, when it was pulled, 16,000, 15,388, 14,258. When you add all those numbers up, you can see inventory of homes for sale up 28% from where we were last year. So last year we were about 141,000 inventory of homes. Still, in comparison to that, look at 2008, 9, 377,000, 353,000, 349,000 homes for sale. The 22-year average is 211,000. So even if we pop up 28%, that would add maybe another 30-ish to this. So 170,000 would still put us pretty far below that 22-year trend line. So as much inventory as we have, we still have some room to go to get to some of those really long-term averages or closer to that 6-month balanced market, which is giving your buyers a little bit more option. Your sellers are having to be a little bit more willing to negotiate on certain things. And again, the other thing too is just we have to be making sure we didn't do seller updates a couple years ago because stuff was selling so fast. But like two things that we've been talking about even inside of our organization is when you launch a listing, everything has to just be show worthy. It has to be professionally presented. You have to have no mistakes. You got to do the best job to make sure that your sellers are coming out with a wow factor. And then the second thing is just consistently monitoring the data, the activity, the showings, the calls on those listings, and then making very quick, corrections or, changes to your listing or price reductions just to make it relevant. You want to be the best home for sale in your local market, whatever those comps are saying.
Well, and just like what you said yesterday, during the COVID times, we basically expanded that market where we bought forward.
Yeah.
So all of those buyers potentially may not have even been in that market, but we took it away from the future.
Yeah. Yeah, and what I reference is when they rolled out after the Great Recession, there was a lot of governmental assistance programs. There was tax credits that you would get when you bought a home if you were a first-time home buyer. And kind of once we saw that play out over several years, we realized with the data that it didn't go out and create any new buyers back in the 08, 09, 2010 timeframe. It kind of just bought them ahead a couple years. So it kind of stole them from maybe 2010 or 11 or 12. And we saw that a little bit with COVID. Number one, there was a lot of money in the market. Rates were so ridiculously low. Your buying power was awesome. And there was also a little bit of FOMO, going on in the market where people like there was just so much craziness, like multiple offers. It kind of almost made people feel left out. What was the stat back then? Like within a year, 25% of buyers regretted their purchase. One of the surveys that we saw. But we saw that huge jump up in units and closed transactions 2020, 2021. We don't necessarily think that it was just a new chunk of buyers created. I think what happened was we bought some of last year's, ahead of time, a couple years just in that current market. Pending sales, again, pretty flat line, down 1.4% on pending sales. Days on market, here's US average days on market, up 12.8% at 34 days. Kind of see the trend. Usually at springtime, you see that days on market go down. Fall, winter time, you kind of see it going up. So we're kind of following that pattern, but only about 3 to 5 days more on market in the US every month as we see that trend. And then here's Utah, which does include the under contract time, but still up 10.7%, 62 days on market, 14-year average 55, but probably just that 2021 was ridiculous. That includes the under contract period. So I know we had a lot of cash transactions, but speed was the name of the game back then. Same trend line, just as you get in the summer, they kind of drop, but still pacing 6, 7, 8 days on market above each month last year. But let's talk mortgage rates. Dang, this is the one I was hopeful that we'd see maybe in the low fives by this time frame. But nope, we definitely haven't. So 6.3 is the latest 2025 projection. 24 is 6.72. Historical average the last 30 years, the green line at 6. The last 50 years, right at 7.72. So let's talk mortgage rates for a second. And I know you read every bit of the Fed's notes when they put anything out, Gordon, so thanks for paying attention. But they met yesterday. Clearly, Jerome Powell, they voted to not lower the Fed rate. They voted to continue it at 4.25 to 4.5. One of the unique things that happened hasn't happened since what 1993. There was two governors of the Treasury that voted against that. So you're starting to see a little bit of dissent. If you read between the lines, it was probably trying to push a little bit for maybe a September cut, but even the market before that and after potentially still projecting maybe 225 basis points cuts by the end of the year, but that's even dropped below what 50% chance or something like that, Gordon.
Yeah, that's what I saw yesterday. And it was interesting. Powell did a lot of explaining.
Yeah,
I
yeah,
I don't know if that's the best analogy, but he did not seem super confident in his decision.
yeah. Why do you think that is? Let's just talk a little bit. Like again, like inflation seems to be doing pretty well. GDP seems to be doing well. They quote unemployment still low and resilient. A lot of that, just the stability is giving him more evidence or the Fed more evidence to potentially just keep rates the same, just to slow the growth down as long as we can and the appreciation and inflation. Any
Yeah,
other insights on that?
I think there's still a lot of hesitation about what's happened in the residential market in 2008 that we're still seeing cracks in the commercial market right now. And I think they're a little skittish about that. Plus, we've got so many issues about what's happened the first quarter or the first half of this year with um, all the tariffs and stuff, people
Mhm.
front loading all of that. What does that do? And it's kind of messed up, as we'll see in a couple more slides. Some of the slides that I really pay attention to on inventories and how that's affecting Main Street, the numbers don't make sense now.
Yeah.
So I think he's getting cold feet about both sides. He
Yeah.
doesn't really know what to do.
Yeah, and the closer we get to recession, being dubbed a full recession could put more pressure to ease those rates downward. You see unemployment come up, you're going to start seeing more pressure on that. But even their long-term projections is only a potential 100 basis points, maybe 1 full percent reduction all the way through 2027.
Right.
And again, we've saw that rate reduction of a 1 percent the last 12 months, and we didn't see rates drop 1%. So I think we just have to have a reality check that we could have these sixes, 6.3, 6.25, 6%. We'd have these for several years. Rates are not going to come save this market. And if you see just slower kind of 3% annual appreciation, you still see income growth. Projections show that we're probably going to still be facing a lot of, unless something crazy happens with AI and robotics and, decreasing in pricing of homes and stuff. But most likely, we're going to see the same affordability challenges probably for the next several years, right? Here's 30-year annual average. You can just kind of see what rates have been doing. Kind of flatlined since they really saw that rapid escalation at the beginning of 2022. Here's your monthly mortgage rates. Yeah, we even saw him go as high as 7.62, which wasn't a great month. Here is weekly interest rates comparing the 15-year to the 30-year, usually around that 0.9 to full percent difference in the 15-year fixed rate mortgage. Here is that 30-year fixed rate mortgage versus funds that we were just talking about. So again, a lot of times you see those lines can be closer together. You can see them widen. So just last year, we were around that 5.3 Fed funds rate. We're now on average down to 4.33. So a full percent reduction. Look at that same time period, 6.64% interest rates, 6.82. So even though we saw a full percent drop in Fed rates, we saw a little bit more in that, which could lead just to more concerns long term, potential credit risks or distressed or whatever. But even the inflation that you mentioned some of the reports I saw, as of now, a lot of the tariff impact, you've seen a lot of companies actually eat that additional expense and decrease their profits. You haven't seen a tremendous amount of those prices being passed on to consumers, but the projections still show as we get more and more of these tariff deals worked out, they still will have a negative impact on prices going up, anywhere from what, 3 to 5% of some of the reports I've yet read.
Well, and then the next couple slides, you'll see that, as we've decreased the balance sheets, that's why that spread isn't there
Yep.
because
Yep.
it's tightening the credit markets.
Yep. Less money. So here's national mortgage. 74% of all mortgages have 5% or less, which this is going down. If we were to pull this, what, a year ago, we're seeing a little bit more mortgages with the 6, 7%. It's just as more turnover of those rates happen. But again, Utah is even higher than that. 80.1% of all mortgages have rates of 5% or less. Even under that 4% number is what? 38, almost 70% of those are under 4%. So here's what you were talking about. The Fed funds rates, purple line, overlapped with just the mortgage-backed securities on their asset balance sheet. We've gone from what, 2.7 trillion down to 2.1 trillion. So basically $600 billion of credit availability almost of them buying those mortgage-backed securities and then pushing them back out into the market has definitely tightened up the credit out there. But then you look at total assets, not just the mortgage-backed securities. We peaked somewhere around the 8.9 trillion down to 6.6 trillion. So we've dropped 2.3 trillion dollars of assets that the Fed held.
And you can see when on both of those slides, when they started aggressively buying, that's what pushed the interest rates down.
Yeah.
And now they're doing just the opposite. And that's why we've seen the interest rates and the 10, because they follow the 10-year. That's why they're not moving.
Yeah. But good news, it's not, of course, we want lower rates, but like the lower that goes, the more option that gives them in the future to be able to buy some assets, lower
Yeah,
the Fed rate, just to give us some more wiggle room to keep the
some breathing room.
economy rolling and robust. So here's the Mortgage Bankers Association Purchase Index. So this is kind of what a lot of our mortgage professionals use just on how many mortgages are being out there. So this covers the entire market of government and conventional loans, up a little, 7.57% on the index, puts us about 156.2 on the index. Index at 100 is kind of just the baseline there. But a little positive growth for our mortgage professionals out there. Here's the weekly one. Weekly Mortgage Bankers Association Purchase Index. Here's the credit availability. Again, you saw this just dramatically decrease, almost cut in half over the last 5 years. We have seen it loosen just a little bit so far year to date, but still right pretty much at that ratio index. So kind of on a monthly basis. But then here's the refinances. Here's your 30 fixed rate mortgage, purple overline, overlap. And then the orange bar is the U.S. mortgage refinance index. So again, we're up a decent amount, 42.2% year to date compared to last year at this time. Starting to see a little bit of recovery on the refinances, but still record lows the last 25 years. It would have been good to be in the refinance business here. And then 2012, that would have been a great time to be a refinance guy or gal. Here is just with a little bit more data on a weekly basis. And let's talk foreclosures, Gordon. Here's what you were talking about, some of that clickbait and what's in the media out there. A total of 170,000 U.S. properties had foreclosure filings during the first half of 2025, up 5.8% from the previous year and up 1.1% from the same time period 2 years ago. So we are seeing a slight upward trend, right, in this. So foreclosure activity continued an upward trend with increases in both starts and completed foreclosures. While the overall numbers remain below pre-pandemic levels, the persistent rise suggests that some homeowners are still facing financial challenges amid today's housing and economic landscape. So typically you'll see a notice of default filed after 90 days. Sometimes that even gets delayed a little bit. You'll see some stats of potential homeowners even behind on mortgage payments, but no distress filing or foreclosure filing was doing that. we still, Gordon, are in agreement that we're still going to continue to see this be pretty dang low, primarily because we're at such a high equity of home ownership that they still have so many more options. Even if people get behind on payments, they always have the option to sell, cash out equity when, when you're underwater or even at your equity level zero. That could be some more concern, but the fact that so many homes in the United States have great equity, it's hard to think that we're going to see a tremendous uptick on this. But I am pleased to see a lot of our market centers starting to throw out some distress, short sale training, just to make sure that we're aware of this in case these type of properties come down our sales pipeline. Here is like right here, only 0.13% of homes have filed for foreclosure of all the houses. 0.13%. Here is 0.15 in Utah. Anything else on distressed? You're muted, sir.
It's just completely different from '08. The credit market is different. We've got equity in the properties. People can't rent for what they've got their home payment for. They're not going to walk away from that home payment and rent something.
Yep, totally true. Totally true. So affordability still challenge, up a little bit of reprieve, up 2.4% in the US at 101, right at that index, the home affordability index. You can see a slight downward trend so far, a couple months of this year. But then look at Utah, just because our prices are a little higher, even though we have a little bit higher income, still down at the 74 on that home affordability index, flatlined so far this year compared to where we were last year. So even though we see prices going up a little bit, rates kind of hovered around the same, maybe wages have gone up a little bit to handle some of that price appreciation, but just flatlined on the affordability. And right around 73 the last 2 months. So let's talk investments and rentals. Again, here, who owns all the single family rentals? Mom and pop investors, 1 to 9, single family rentals owned. 80% of them are in that category. Regional investors that are 10 to 99 rentals owned, that's 14%. Really, still a small percent are those small national or even those institutional investors. But we're seeing a little tiny bit of uptick on that, right? And some of those institutional investing. Yearly average rental rate. So this is a new chart that you just created. Gordon, tell us about this.
So the U of U puts out this every year to year and a half, and I found it interesting that we're hovering around that 18-year average of 5%. So you can see some we've gone backwards. 2024 pretty flatlined, with the exception of Weber County. It's surprising to me how much rents have gone up, over this last 10 years.
Yeah, 5% surprised me too on this number. Even Utah County, where I'm at, clearly 2021 was just such a giant
Oh yeah,
year
crazy.
for escalation of rent. But we kind of felt that flat line filling last year. And I think you'll see that in the data, but we just went through one of the record multifamily apartment building time periods in the state of Utah that we've ever seen. There was a lot that came on. So I think it was almost, even though it didn't tap into the full long-term shortage of homes, like the near term, it kind of over projected that a little bit. And there was a little bit extra inventory, which I think kind of just increased vacancy slightly and then just kind of flatlined the rents. So we didn't see that increase last year.
Yeah. And
Here's
we're not seeing it this year either
still kind
so
of
far.
flatline. Yeah. So you can see Utah average rental rates. Here's rent growth. Just like you said, the counties, we saw Weber County saw a little bit the last couple years, but pretty much flatlined the last 2 years. Here is the 2025 fair market rent set by the HUD, the Federal Housing Assistant programs at the Department of HUD. Here is every county, whether it's studio to 4 bedroom, what the HUD sets as the market rent for the housing assistance that we use as a decent trend line. But again, we've been outpacing that here. So they're behind in some of the categories. But here's one of the great sources. We have Salt Lake average rent. Year to date, 4 bedrooms, 3,011 in Salt Lake. You can see the 3 bedrooms, 2,315. You can see that four-bedroom flatlined basically since last year. We've seen a little bit of reduction in the three and two bedroom, specifically in Salt Lake. But then compare that to the far right numbers, the HUD. Four bedrooms, they're really far away. They're actually pretty decent in the studio one bedroom projections, but definitely behind on that four bedroom. So here's the housing profile. Not shortage of homes for ownership, but even shortage of rental homes, affordable and available for extremely low income rentals. Were 48,000 of those built. And we were talking yesterday, a lot of the cool projects going on around the state, Utah City I pay attention to. We talked about the Point. A lot of them are not solving for the affordable rental category. They're even like more of the higher end type of apartment complex because that seems like the developments that seem to still be kind of making money. It's really hard to go in and build affordable rental units right now.
And the last release I read this last week about them breaking ground, they've changed a lot of that affordable housing. It they pretty much didn't talk about it at all. They just kind of skipped over. They addressed it a little bit that they have reduced, but they didn't say anything about how much. So my guess is that it's just not going to be there.
Yeah. Yeah, I agree. It's hard to build and then get that rent down where it needs to be with just the
Right.
construction costs, labor costs, all that, land costs. U.S. median asking rent, all bedrooms, you can see right, pretty much flat line, but just we've pretty much been at the same rates median wise all across the country for almost 3, 4 years since we saw that giant pop of the 20 to 25% in a lot of markets. Median asking rent, year over year, month over month, kind of just been hovering around that 0% line for a while. States rent growth, again, pretty much flatlined the last 3 full years, which is hard because prices have grown up. I got all my property tax notices in the last several days. I'm proud to say one of them went down. Every other one of them went up quite a bit. HOA fees are going up, maintenance fees are going up, property management fees, like everybody's doing price increases. Rent is not, even if you had a great rate of several years ago, the cost and the profit just continues to erode in some of our single family rental categories. So this is great. I'm glad you pulled this. This is average rental days on market. So this is all bedroom markets. You can see US days, you can see Utah days, and then you can see Utah County days just for comparison. Year to date across Utah, the average rental sits on the market 40.1 days, which is above the US days on market 32. Even Salt Lake County, pretty much similar to Utah. But that could have been potentially some of that immediate oversupply and the lack of the affordable rental units out there.
And Weber really got hit. So I think they are contributing to that overall.
Hmm. Okay. So US new build for rent, two or more units completed. You could see 5.8. So it's at 580,000 across the United States. We were pretty much similar time frame, so we must have saw just a tremendous amount of inventory late 24
Huge.
come on. But I'm guessing we're not going to see that wave the last 6 months of this year, nowhere near. I bet we're probably pretty dang close to that line, if not lower.
Yeah, they think it's going to be lower.
Because a lot of apartments that are getting finished right now,
Yeah.
again, they started those 3 years ago.
3 years.
Rental vacancy rates, you can see this has, ticked up a little bit in the United States, officially at the end of last year, 6.8%. Utah still a little below that, but at 4.8%. Rental vacancy by county as of quarter 1 this year. This data source is very delayed for us, but you can see this is what you were talking about. Davis County, Summit County, vacancy rates. Utah County right at that balanced number. Cache County still really low the first quarter. Washington, Weber County. Here's the annual average operating expenses based on quarter 1. Utah County, 5,661. This does not include principal and interest. Summit County, 8,650. Cache County. So let's talk about the economy. Real GDP growth here is on the year over year change. So 1.7 is what we're projected to year over year change from last year. You're still seeing GDP positive growth, but let's hit the quarterly. First quarter, we were negative 0.5%. There was speculation that the number is going to come in a little bit lower. I think that we were projecting somewhere around the 2 to 2.4% GDP growth. Yesterday was fairly surprising when it came out with 3% GDP growth. Again, what's pulling the curtains back, Gordon? Why do you think there was a bump up in GDP, specifically in quarter two, that you
Uh,
might be concerned about?
they're front loading.
And what do you mean by that?
So they're to get ahead of a lot of the things that the Trump administration is putting in place with tariffs. They're oversupplying everything in advance for Christmas because it takes 6 months
Yeah.
to get some of that stuff in.
Yeah. Yeah, you saw some of those hit the headlines, like the big companies, like as soon as the initial China, the bigger tariff was announced, the deadline was announced, and tariffs happen not when it reaches the country, when it actually leaves the port of the foreign country. So the like even companies like Apple, they chartered what was it, 567, 747 jets and filled them with iPhones to get them out of China before that next couple days deadline approached. So you even saw some of those companies that were just moving massive amounts of their inventory in ahead of time over the last quarter. So you think that potentially was some of the GDP growth or the GDP from quarter three or four that was pre-bought into quarter two. So
Yep.
not only would that number have been lower if it would have been normal and not pre or front loaded, we also could see potential challenges in the future because now they're going to have excess inventory that they're already sitting on. So the likelihood of seeing really low or maybe even negative numbers coming out the next two quarters is a high possibility.
Possible. And that's why the Fed is kind of skittish about reducing the rates because they just don't understand what's happened with that inventory challenge.
Yeah. U.S. unemployment, which is also what the Fed references quite a bit, is just we continue to have a very solid, robust, unemployment or job market in general. Unemployment's usually still really low, 4.1 average year to date for the U.S. unemployment. Pretty healthy number right around there. U.S. unemployment job openings. This is where we've seen some movement. 2022, we had 11 million jobs open unfilled. That has dropped to 7.5. I do think this is a little bit of a lag. I think you're going to see this even trickle down even more, and then you start seeing the unemployment potentially pop up. Here's some of the regions where you're seeing job openings and job quits. So more job openings or job people quitting their job. South, some in the South, down 15% in job quits. But then even the West, we've seen an increase in job quits. Midwest, you saw a lot more job openings decrease. Somewhere in that South, you've seen more pop up of job openings. Here's the real unemployment, includes marginally attached and discouraged workers, whereas the U3, which is the blue, only counts those who have looked for work the last 4 weeks. So the more pessimistic unemployment number could be at that 7.8, which you're starting to see that go up a little bit. Here you see on a monthly basis, not dramatic swings, but just moving up. Annual labor force participation, you haven't seen this move too much, but you see 68% of all the civilian population is in the workforce in Utah, above that 62%. Real wages. So real wages isn't just the actual wage increases, it's also weighted against the inflation in that same time period. So even though we saw increases in wages 2021, 2022, because inflation was so high, your spending power was actually lower. So even though you were getting maybe potentially pay raises in, normal jobs out there, your real wages or the filling of that money was down. But we have seen a little bit of movement, 0.8, 1%. This jumping quite a bit. If somehow AI and robotics just really increase the productivity, get real wages up or whatever, this is what could also help save us on the affordability if we see no more changes. Here's real average hourly earnings on the monthly basis, what they're doing in the United States. Weekly payroll. And let's hit inflation, which was in every news article ever a couple years ago. But we have made a lot of progress on this. We got down to what, 2.4, 2.3, just on that CPI that includes energy and food. The core CPI, which is the teal blue line, that excludes energy and food just because sometimes that is a lot more volatile. You can see that is 2.7. Fed target is at 2%, but we have started seeing those numbers move up the last month, 2 months, which could have a little bit of the tariff impact. Annual inflation, comes out from KW's research department. Projections are 2.8 on the including energy and food, and then the core CPI 2.9. And then you see 2026 is really where you start seeing that get back down to that baseline from our projections. So you break out a lot of the categories where we've seen the price increase or decreases clearly over the last 12 months. Natural gas, which has been an interesting one, that jumped up 14.2%. When you look at all gas, just because we've seen fuel prices actually come down, food away from home, food at home. Where does DoorDash go into there? Is that away
Right.
from home, home? Okay. All items, but this is what you're showing the actuals, not what the government puts, because they put rent growth at 3.8% the last 12 months. When you actually look at the real rent growth, it's down or flatlined, right? Median home price increase, interest rates. So potentially using these numbers would alter that inflation numbers a little bit.
Yeah, and they're backwards looking at the Fed on the CPI. That's the challenge I have when what we're actually seeing in the economy isn't what they're reporting.
Hmm. Delayed. PPI, Producer Price Index. You've seen that 2.3%, but overall kind of trickled up this year, right?
Yep.
And then PCE, this is another one that you talk about often. This is personal consumption expenditures. Like, are we spending more money personally or are we decreasing our spending? We're seeing that still increase pretty much every quarter. So 1.4%. Inflation targets, right there around 2%. Any comments on this, Gordon?
Nope. And this one right here, like the last two quarters, they adjusted up.
Hmm.
So again, that's a little bit of a challenge. And that this is the one that the Fed pays most attention to, even though we're flatlined. We were at 2.3 the last two quarters, and they adjusted back up this quarter, those last two,
Hmm.
2.4. So it is accelerating.
Yeah. Revolving consumer debt down a little bit, but pretty much flatlined, which is great. Hopefully, we're getting debt in control a bit. And this is interesting too. So far, federal debt slightly down from 36 trillion 219 billion down to 36 trillion 214 billion. Where'd that 5 billion go? Gordon, do you have that?
Yeah, I wish.
But with the new spending bill that was passed, clearly, that's projected to add more to the deficit. Here's federal debt, total average public debt as a percent of GDP. Slightly down. Again, been hovering at that 120 since COVID. Personal savings rates. Do you have another one? Here we go. This is the one I like. Annual personal savings rate of disposable income. So as soon as COVID happened, we were locked in our houses, so we had to keep our money, so we couldn't go do as much stuff. But people panicked, and we were just like, we better have some cash in our bank account. So you saw a giant increase. Also, when they start giving a little bit of COVID money to people, people were putting that in the bank versus spending it. But it jumped up. Then we started spending it. Then we really started spending it. And then the last couple of years, we've kind of slowly recovered. I think people are, trying to be a little bit more diligent on spending, get their disposable, savings rate up. And then also we saw average deposits of all commercial banks jump up a little bit so far year to date. Huge jumps over here, but again, this tends to be positive. More deposits also could help ease the tightening of the credit availability as well.
It's funny, look at 22 and 23 when everybody was just shopping like crazy.
Mm-hmm. When you bought your Tesla, wasn't
Last year, or actually this year.
it? Manufactured durable goods. This is new orders. You're seeing up. So this is in volume.
Yeah, and this is what is crazy to me. The volume is going up because of the tariffs. They're bringing so much in to do manufacturing as well. But then when you get to the other numbers, they just don't make sense anymore.
Because right here, the manufacturing index is based a little bit more on almost like we have closed units and then closed volume. This is talking about just the quantity of products and whatnot. It's moving in a contracting direction, which means less stuff is being produced, But when you look at the volume of the manufacturer's stuff, like the prices of the stuff that's being manufactured right now, which this predicts what we're going to be buying things for usually, 6, 12 months from now, right? So this is another concern about looming potential inflation is that just the volume has increased even though the units of manufacturing's decreased. Pretty much like the real estate market, units went down, volume's still been going up. Anything else on this?
Nope.
Advanced retail sales percent change. So again, this is the retail establishments, a lot of their advanced purchases. And then here's the U.S. Index of Consumer Sentiment. This is, more survey based, but again, we dropped so far this year. 20% drop, which is pretty significant. Just on the sentiment out there, the index trend line, the percent change. But then you see Utah, which we talked about this yesterday. Even the United States dropped. Utah, we are just so happy. We're so happy. We're positive. We're optimistic. So we're at 84 on the consumer sentiment.
Well, and the Utah economy is ripping. That's
Yeah.
why.
Yep. So you can see on a month-to-month basis, you do see a little pop up of the U.S., but still 22.3 above on the index for Utah. So let's talk about the Utah economy real quick. Thanks for putting some highlights in. Utah maintains its #1 ranking in economic outlook for the 18th consecutive year. We just have a fantastic economy for the most part across the state. Job growth, low unemployment, strong GDP performance continue to underline Utah's status as a national economic leader. Major strengths, clearly we talk about this, the young educated workforce, our median age is a little bit lower. We have a highly diversified economy. We're not relying on just a handful of different industries. Positions the state for sustained resilience and competitiveness, even amid national headwinds. Clearly, the challenges we've talked about, housing affordability. Home prices in Utah remain high, putting pressure on affordability, especially for new entrants and renters. Supply constraints have kept prices elevated despite rising mortgage rates. Balanced growth, while the overall economy is resilient, some sectors, notably tourism, are showing signs of contraction. I saw potentially like $15 billion less in tourism or something across the country this year than last year. Some of the numbers I saw. But economic growth remains uneven across regions and industries, and challenges in new labor supply and housing affordability are leading concerns for future expansion. Even Austin, Texas, which I traveled to quite a bit for KWHR, KW headquarters. Austin's one of the biggest, depreciation markets right now. And then you got inflation and interest rates. Inflation has moderated but remains sticky. Higher interest rates have started to soften labor markets, though Utah's job and low unemployment has buffered many potential impacts seen elsewhere. Summary, 2025, Q2 remains robust and resilient. Unemployment growth, strong GDP, low unemployment outweighing challenges of housing affordability. The state is expected to maintain solid, albeit moderating economic momentum through the remainder of 2025. So here's our unemployment. When you look at that, still under the United States, 3.2%, monitored on a monthly basis, seeing that trend. And then here's some of the industries. So this is new and you added, but life sciences and healthcare in Utah, that is a very expanding industry. You see manufacturing and technology, outdoor recreation, even energy and mining. I even saw the tariff that Trump put on copper imports this morning. That's going to probably affect, Kennecott and some of that. So all these are positive. This is some of the industries that are really leading the growth of Utah right now for us. Even the percent change from Q1 compared to Q4 in 2024. And a lot of times Christmas, you see so much activity that you should potentially see a negative drop in Q1. Just spending might go down. But even in Utah, Q1 was better than Q4 of 2024. Here's all GDP, again, just continue to grow. We kind of double dip. Our economy's growing, great state. We have a positive population growth, all kind of contributes to this continued rise up. Here's our personal income growth. Utah still slightly outpacing the United States, but 7.2% income growth percent at annual this Q1 to Q4. Again, 7.2% income growth, which is great. We like to see that to catch up on the affordability. And then let's talk about construction. Again, here is the U.S. new single-family home starts, 967,000. Traditionally are at that million number. Here is residential housing starts, right here. Residential building permits, you can see this trend line, the orange, residential building permits, and then you see total building permits. Either way, the last 3, 4 years, you're just seeing those that trend line or that slope go down on the permits being pulled. And here's housing starts. So residential building permits is the orange, total building permits, and then residential permit change. So this is based off the actual residential building permits. We're a 19% drop so far, almost 20% drop in residential building permits pulled. So even though we've been under building, we're actually projected to even underbuild way more the next 12 months, right? Housing starts value in billions. This is Utah. So even though we're showing 20% drop in units, permits pulled, the volume we're still seeing sustain because of that purchase price. And they might even be building higher level stuff versus even the median purchase priced level inventory. Okay, price of index homes under construction. So this is kind of when it's under construction, what the index of the new single family prices are. Slight increases. You're showing 2.6% increase of pricing of under construction homes. Multifamily, you're seeing price index slightly up 3.3%. A lot of that's due to costs. Builder confidence, we've seen a drop down 17%. 39 now, 39. So let's look on the monthly basis. So again, right when COVID happened, you saw that drop to the 30s. No one wanted to build because they had no idea what was going to happen. It rebounded very quickly. We went through that heyday of just building, like build as fast and as many as you can is what builders' mantra was. We saw that drop as interest rates started significantly going up towards the end of 2022, dropped down to 31. We recovered, a little bit of seasonality in here, dropped again, recovered, dropped again, recovered. But what's weird is normally we'd be at the 40s, 50 range the last 3 years, but here we are June and it's at 32. This is a nationwide stat, but 32 on the builder confidence. And then here's just some general debt numbers to watch. Total debt balance and its composition. So you just see mortgage debt in the country. You are seeing some increase in home equities. So I would expect this to grow over the next couple quarters. You're seeing a lot of advertisements for people to be able to tap into their equity with different products, auto loans, credit cards, student loans, and then other. Mortgage originations by credit score, still that under 620, not a big portion of our mortgage originations. But again, that 760 and above, still predominantly the number one. Auto originations by credit score, still a little bit more well distributed. Total debt balance by delinquency status. So you see 2008, 2009, a lot of defaults, car repossessions, credit cards, all that stuff. Quite a trickle up in quarter one. And I'd say quarter two probably trickled up too, but I know this data is a lag. Percent of balance 90 plus days delinquent by loan type. So look at the purple is credit card. So we're journeying to 15% of credit card balances 90 days or more delinquent. You're seeing other categories, but look at mortgage and HELOC still very record lows, the green and the blue. This is all the red is all legislation. So they were going to forgive some student loans. Now they're not forgiving them. So just immediately quarter one shot up journeying to 10% of student loans 90 plus days. And that's all just.
And this goes back to what I said earlier about, their people's mortgage is cheaper than rent. They're going to let their credit cards and their auto go before they let that home payment go.
Yep. Yep. Transition into serious delinquency by loan type. Same thing, HELOC, mortgage, trickle up a little bit.
A little bit.
Really, just student loans. You did even see credit cards. You saw, some of those others kind of flatline in the serious delinquency. Number of consumers with new foreclosures or bankruptcies. Orange is foreclosure, bankruptcies actually went down the last couple quarters. Even that peak, 2006?
Yeah, before we started seeing a lot of that.
1 million people filed bankruptcy that quarter. Third-party collections. Oops. Third-party collections. Proportion of consumers with collection has actually been decreasing, even though the average collection amount per person has kind of been increasing, but quarter one, third-party collections. And that is it. So, Gordon, final tally, summarizing the market, maybe projections, anything you want to say?
Just I I would say just stop paying attention to all the clickbaiters. It's not as bad as a lot of the news is projecting. We're just going to remain stable for the next year or so.
Yeah.
And there's always going to be homes that have to sell for whatever reason. Death, divorce, babies,
Yeah.
that stuff doesn't go away.
Yeah, very moderate price appreciation in the next several years, two, maybe 3.5% over the next several years. I still think that we'll see a little bit more units sold this year than last year, but it's going to feel a lot like last year. Mortgage rates might ease, moderately, just slightly over the next 8 months, but even affordability is going to pretty much stay the same. Like I really feel like the remainder of this year is going to feel a lot like the beginning or last year. And then as we journey into 2026, a lot of the potential changes you're seeing get kicked farther and farther down the road. So even the beginning of 2026 feels somewhat stable. So if you just think all of a sudden something's going to change, that would then in turn change your lead gen strategy or your communication strategy. Just know, all right, what if we're in the same market that we're in now for the next year, maybe even 2 years? Does your mindset change? Do you just kind of just deal with the reality and just keep moving forward? But overall, still generally a great market, moving more in that balanced arena. So
And our industry's been in a recession for the last couple of years. And, if we follow some of that data that we outlined in the earlier slides, I think for the rest of the year, we're going to start seeing, I think we've seen that bottom and we're going to start seeing the residential come out of it.
yeah, yeah. Yeah, and globally, hopefully, we're just seeing a little bit more peace and, a lot of the conflicts that have risen up the last 6 months. I think even we're starting to see more and more of the deals cut. Japan was cut, Philippines was cut, Thailand was cut. Like, so the more of those deals that are locked in writing will be better for us to project what could, how that could affect the economy. But overall, stay solid, attend your training in your market centers and lead generate. It'll still be a fantastic year. So, again, these are on kdbutah.com. kdbutah.tv is the recording, and even some of our insights and trends talking points will also be on there this time. So thank you, everybody. Thanks for joining us, and we'll see you next quarter on our quarter 3 market report. Have a great day.
Thanks, everyone.
See ya.